Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm here at HSBC with Paul Bloxham, who's the Chief Economist for Australia and New Zealand. Thanks for making some time for us, Paul.
No problem.
Now, you've been in the news quite a bit with your comments about the New Zealand economy this year. The comment that New Zealand could be the rock star of 2014. It's a great little line. It's got a lot of traction. Just wondering, now, to what extent do you think that this is because of good things going on in the New Zealand economy, and to what extent is it because of problems in other economies?
It's a bit of both. It really is a bit, in the scheme of things, that the OECD economies are still struggling after the global financial crisis, particularly the advanced world, and New Zealand is picking up pace. So it is a combination. If you look across the range of the OECD economies, the developed world economies, we think that New Zealand will be up in the top 4 performers across the OECD economies this year, and that's why we've been calling it the rockstar economy of 2014. So that outperformance across, in terms of New Zealand outperforming most of the developed world, is driven by both stories. It's driven by the developed world only recovering slowly, and New Zealand being expected to boom.
And what are the particular factors in New Zealand that you like, or that are driving this New Zealand economy at the moment in your view?
Well, there are 3 key things. The key things are the Canterbury rebuild, which has gotten going and of course is enormous. The RBNZ's own estimates suggest that it's going to be 20% of GDP. If you compare that to the size of the mining investment boom in Australia, it actually compares, it's a similar sort of size. If you add up all the mining investment that's happened in the last 8 years in Australia, it adds up to about 26% of GDP. So we're talking about a rebuild story that's almost as big as the mining investment boom, which has been a huge story for Australia. So you can say New Zealand's at the beginning of this, whereas Australia is, of course, at the end of their mining investment boom. The second big factor, of course, is dairy prices are at very high levels, and that's supporting rural incomes. The terms of trade's at its highest level in 40 years, and we think those trends are going to be sustained. We think the demand for dairy products and meat products is going to be sustained as the middle class incomes rise in China. That story has a lot of support and is going to persist in our view. And the third factor is low interest rates, interest rates have been low in New Zealand for quite some time now, are supporting a pickup in the housing market. You have a housing boom, and it's not just happening in housing anymore. You're seeing that pickup in house prices is flowing through to consumer confidence, it's flowing through to quite strong growth in retail sales, and you'd expect to see more of a pickup in consumption soon. So the economy really is firing on all cylinders. It's a pretty broad-based recovery we've got in mind.
Yeah, and this is the report you put out is indeed called New Zealand in 2014 firing on all cylinders. One thing I noticed in it is you didn't make mention of the current account deficit. Now, that's about, I think the last annual 1 year to September was about 8.8 billion, about 4.1% of GDP. That's something that some economists are still quite nervous about in the New Zealand context. Are you concerned about that?
Look, I'm not as concerned about that. I think the reason why you've got a large current account deficit is partly because investment is running well ahead of saving. That's what the current account deficit is. It's saving less investment. So you've got a fair bit of investment going on, a ramp up going on in Canterbury and investment in the economy more broadly, and you don't have enough saving to provide all that investment to do what is productive investment within the economy. So I think the current account deficit is apparent, not for reasons you should get too worried about. But saying that, it is worth keeping in mind that New Zealand's saving rate overall is not that high. So it should be a priority of policymakers to find ways to encourage an increase in saving within the economy. Now, the government itself is doing some of that. We know the government is headed towards budget surplus, and they look on track to achieve their objective of getting there fairly soon. And of course, so that's helping to fix up the saving situation. But I think you still need to see more private sector saving within the New Zealand economy, so that in the medium term, that current account deficit is sustainable and also potentially a bit smaller than it is right now. But overall, I don't see it as necessarily a big issue, as I say, because it largely reflects that investment is running ahead of saving. You just haven't got enough saving to do all the investment you want to do.
And one of your 3 key drivers is low interest rates. Now, obviously, you among pretty much all economists are picking the Reserve Bank to increase the official cash rate this year. I think you're picking about 100 basis points of increases this year and another 100 next year, which would take us up to about 4.5%. What sort of impact do you think that might have on the economy?
Well, as you know, to tie back to the beginning, managing a rock star is quite hard. the economy is picking up pace, and policymakers need to consider that when the economy is picking up pace, you need to respond to that with policy response. You wouldn't want your rockstar economy to become addicted to low interest rates. And so we do think that interest rates will need to rise fairly soon. And as you say, we've got in mind that they will rise by 100 basis points this year, another 100 basis points in 2015. What will that mean for the economy? Well, it will help to slow down the housing sector. It will help to contain some of those pressures that are building within the domestic economy. Of course, one of the other things that it'll do, it'll probably provide continued support for the New Zealand dollar. And that's one of the things that has really worried the RBNZ. In our view, it's probably worried the RBNZ a bit too much in the scheme of things. A high New Zealand dollar at the moment reflects the fact that the economy is doing well, that it's doing better than others, that it is looking as though it's going to be an outperformer when you look into 2014. And we think that New Zealand dollar is going to stay high. We think it's just something you have to get used to, that the New Zealand dollar is probably going to stay structurally higher than it's been in the past as a consequence of the outperformance of the New Zealand economy.
And your report notes that your Forex team is picking that the New Zealand dollar will rise to about 87 US cents this year, which is getting up towards historic highs, and possibly even parity with the Aussie dollar. What odds do you put on parity with the Aussie dollar, and what impact might that have on the New Zealand economy, do you think?
Look, it's our central case that as the RBNZ starts to lift interest rates and the economy continues to show signs of strong growth, that the New Zealand dollar will appreciate a bit further from here. And at the same time, we're a bit more downbeat on the Australian economy. Things have slowed down a bit. The mining investment is going to peak and is going to start to fall into 2014. So we have in mind that the Aussie dollar might actually come down a bit. The combination of those two factors means, of course, we think that the New Zealand dollar may get to Aussie dollar parity sometime later this year. We think that might happen. In fact, it's our central case. And indeed, that would be the first time in 40 years that the New Zealand dollar got through Aussie dollar parity. But it's a combination of those stories. It's both because of our stronger outlook for the New Zealand economy, but also because we think the Aussie dollar will come down as you look through this year.
Now, obviously, New Zealand is a small trading nation with an open economy. Our two key partners these days are Australia and China. Now, obviously, there's a bit of concern rumbling away about China and whether there might be a slowdown in China. Well, there is a slowdown, but to what extent there'll be a slowdown. The shadow banking system, and I guess the glass half full people say, well, heck, we're exporting huge quantity of our dairy products now are going to China, so we're really dependent on that. So what's your outlook for China?
Well, I think the first thing I would say is those who are out there who are giving commentary suggesting that we should be worried because we're strongly tied to China. I think you're kind of not seeing the full picture here. Actually, the whole reason why, or a key reason for the relative success of both Australia and New Zealand now this year and into the coming years is because of the strong ties to China. You can't have it both ways. You either, the fact that the economies are doing better or outperforming, Australia and New Zealand have been outperforming, is because of the strong ties to China. And in terms of our outlook for China, look, we have in mind that Chinese growth will be similar this year to the rate that we saw last year. We think it will be 7.4%. That's our house view for the Chinese economy. You're right, there are some risks. The Chinese are very focused, the policymakers are very focused on issues within their shadow banking system. They're well aware that their shadow banking system has expanded more rapidly than they're comfortable with, and they're looking for ways to try and tighten up financial conditions outside of the banking sector, in the shadow banking system, and see more of that credit brought back onto the balance sheet of the banks. That's one of the key things the policymakers are focused on this year. We think that the Chinese are going to be focused on quality growth rather than quantity of growth, in the sense that they are looking to deregulate and liberalise their financial system further and try to sort out those problems that they see in the shadow banking system. The question, of course, is can they do it in a way that isn't disruptive, that doesn't see a significant downturn? And our view is they can. We have the view that the Chinese authorities have the capacity, have the ability to be able to continue to grow their economy at 7 to 7.5%. As I say, we're penciling in 7.4 for this year. Without too much disruption, even though they're gradually reforming their financial system.
Now, the New Zealand housing market, especially Auckland, has been in the news a lot, obviously, in the last couple of years. Reserve Bank's been quite worried about the Auckland market, the price inflation in the Auckland market. They've brought in the loan-to-value ratio restrictions on mortgage lending. We've also got migration that's on the rise, and we've also got supply issues which have been broadly discussed in the government and the Auckland Council moving to try and address those. Do you think that there is a housing bubble in Auckland, and how concerned should we be about our housing market?
Look, I don't think there's a housing bubble, not yet. I think that at the moment what you could justify what's going on in the housing market largely on the grounds of fundamentals. Supply is weak, as you say. You haven't been building a lot of houses here in Auckland in recent years. Demand is fairly strong for a number of reasons. One of them, of course, is that you've actually seen a very large pickup in inward migration recently. Fewer Kiwis are leaving New Zealand, more are coming back, and more people are moving to New Zealand as well. So those migration rates are running at very high levels. So strong demand, weak supply drives up prices, and then combine that with the fact that, of course, interest rates are very low and have been for quite some time, so there's leverage available, and that's seeing the housing market lift, that has that pick up quite strongly. I think those are fairly fundamental factors that are driving the housing market. But I do add one caveat, and that is interest rates have been low for quite some time, and it will require that the RBNZ starts to lift interest rates fairly soon, or else I think there will be worries that potentially the housing market may start to overinflate, that it may move beyond those fundamentals. And the introduction of loan to valuation ratios, restrictions by the RBNZ has been one approach to try to do that. I think it's had a fairly minor effect in the scheme of things, and I think it will require that they actually start to lift interest rates rather than put in place or manipulate macroprudential tools to make sure that the risk that there is a housing bubble is actually contained.
Now, we've also got an election in New Zealand this year, which are always hard to predict with our MMP system. If there was, for example, to be a change of government to a sort of Labour-Greens coalition, what impact do you think that might have on our rockstar economy, especially given they've talked about changes to monetary policy and also potentially nationalising of the power sector?
Look, I think a lot of care has to be taken in particular with regard to changing the framework for monetary policy. I think the monetary policy framework has worked fairly well in the scheme of things. I think what you've got here does work fairly well, an inflation targeting regime, and it's been well implemented, and it's been a key thing that's made the New Zealand economy more stable than otherwise. So I think some caution should be exercised in that regard. The election's obviously going to play into and have an impact on the economy. Elections tend to create a bit of uncertainty, particularly in the lead up to them. So it's potentially going to be a bit of a dampening force as businesses are not quite sure what's going to happen in the post-election environment. But I think the momentum in the economy, in the New Zealand economy, is strong enough that it should actually have only a fairly limited effect, whichever way it goes, whether there's a change of government or the incumbent stays in power. I think it should have a fairly limited effect because there are such strong forces that are lifting the New Zealand economy at the moment.
Now, just a more lighthearted question to end on. I mean, if the New Zealand economy is a rock star, is it going to be a sort of a one-hit wonder or a rock star that's going to burn out quickly, or is this going to be a long-term sustainable sort of Mick Jagger type rock star?
Look, I like to think that it's going to be a sustained story, that it's going to be more like Mick Jagger than Justin Bieber. I think I like to think that that's the way it's going to play out, and the reason why I think that's the case is because you've got some fairly good fundamentals, and taking the broadest view of those fundamentals is to say New Zealand's got very strong ties to the Asian economies, and those ties are growing. And the Asian economies are growing much faster than the Western world, and of course they've got a long way to catch up yet. It's still the case that the bulk of the population in China is poor and living in the countryside and needs to move to the cities. And as that happens, as that process continues, as GDP per capita rises, that will mean that there will be shifts in diet, there'll be shifts in the sorts of services that are consumed. And I think that New Zealand and Australia as well are right on the doorstep of this story. Very strong ties to the countries that are going to grow most quickly. So taking advantage of those things is of course a challenge, and policymakers need to keep that in mind, that there are going to be continual challenges as the economy changes structure to take advantage of the emergence of Asia. But I think that does mean, those strong ties to Asia mean that you should be fairly optimistic about the outlook for New Zealand.
Well, thanks a lot for that, Paul. That's Paul Bloxham, who's the Chief Economist at HSBC for Australia and New Zealand, and I'm Gareth Vaughan at interest.co.nz.